Welcome back to the Deep Dive. We are digging into a huge stack of data this week, economic indicators, from just the last few days, January 11th through the 14th.
That's right. And we're using it to analyze the structural health of the two biggest economies really challenging the current global order, Russia and China.
And if you've been following along, you know the mission. Both Moscow and Beijing put a ton of effort into projecting this image of, deep stability, of resilience.
But our job is to look past that, because when you peel back the layers, the numbers show something very different. They show debt, structural strain, and, well, a really painful disconnect between state power and the well-being of the average person.
And that gap is where the real story is.
It's everything.
Okay, let's unpack this, starting with the continuing, and I'd say escalating, economic costs of the conflict in Moscow. Last week, we talked a lot about that sugar rush effect, the massive spending that led to high inflation and those really punishing interest rates.
We did.
So what's the hangover looking like? What are the latest figures telling us about the high price Russia is still paying to keep that war machine running?
We are absolutely seeing the hangover from that sugar rush. Officially, Russia is reporting, well, modest GDP growth, somewhere between 1% and 2% annualized for 2025.
Which, for a stable economy, might be okay, but for a nation trying to get back on its feet, that's basically stagnation.
It is. And more importantly, that small number is completely hollow.
How so?
Well, the crucial nuance, and this is confirmed by organizations like the IMF, by independent Western analysts, is that this growth is almost entirely war-driven.
So it's state spending.
It is. It's spending on shells, uniforms, military salaries, replacement equipment. All of that inflates the GDP. It is not organic consumer spending. It is not innovative private sector investment.
So it's an economy structured to fight, not to actually grow into the future.
Precisely.
But hold on. If the state can keep this deficit spending going and the military is still funded, doesn't that prove the sanctions aren't really working as designed? Are we overstating the pain here?
That's a fair challenge. The state can fund the military, yes, but for now, look at the mechanism they're using.
Okay.
They're running these persistent, widening federal deficits. Military spending stays high, which is actively crowding out civilian spending.
And when we say crowding out, you mean?
I mean the money for pensions, for health care, for just basic infrastructure maintenance. It's all being diverted to the war. The assessment is that Russia is sustaining the conflict by slowly but surely impoverishing its own population.
And eating into its own future.
Exactly.
That connects directly to inflation, which we know they tried to crush with those brutal rate hikes last year.
Right.
What's the situation now?
The official line from the central bank puts inflation between 4.5 and 6.5%, but it is ticking up again.
Why?
Partly the weak ruble, import constraints, but critically because of these severe labor shortages.
So households are still feeling it.
Oh, absolutely. They continue to report inflation as their #1 concern. Because costs for the things that matter, food, medicine, utilities, they're rising much faster than wages. The headline number might look controlled, but for the average family, their paycheck is just losing power.
And that labor shortage brings us to that really strange paradox in the employment figures. Russia is reporting record low unemployment, about 3%.
Right.
In a healthy economy, that would be a sign of a boom.
And here, what's so fascinating is that it's the absolute opposite of health. That low unemployment number is a direct reflection of a dysfunctional labor market, a market broken by the war.
Because you have hundreds of thousands of working-age men just gone. Mobilization, war deaths, emigration.
All of it. So you have fewer people chasing fewer jobs. It creates some artificial wage pressure, sure, but the net result for everyone else is a decline in goods, in services, and higher prices.
A negative feedback loop.
It is. The assessment is that Russia can keep this up through 2026, but the strategy relies on sacrificing the future. It's a high-cost, high-risk trade-off.
It's clear Moscow is paying a heavy internal price.
Right.
But it seems like the Western allies are determined to amplify that pain. They're not just maintaining the status quo, are they?
No, they're tightening the screws. And the biggest signal this week really comes from the United States.
Okay.
We saw Senator Lindsey Graham announce President Trump's approval to advance the Bipartisan Sanctioning Russia Act of 2025. This was on January 7th.
This sounds like a major escalation. We should be clear for everyone listening. What exactly are secondary sanctions? Why is this such a big deal?
Secondary sanctions are essentially economic guilt by association. This act would empower the president to hit companies and countries outside Russia.
So not just Russia itself.
Exactly. Anyone engaging in significant transactions with them, particularly buying that cheap Russian oil. And the bill explicitly names China, India, and Brazil as potential targets.
So if a Chinese company keeps buying discounted Russian crudes, this bill means that specific company could face U.S. sanctions. It forces them to choose between the U.S. dollar system and cheap Russian oil.
Precisely. It's a direct attack on the revenue streams funding the war, which is why China has already protested loudly.
And at the same time, Europe is busy closing its own loopholes. They're gearing up for what would be their 20th sanctions package.
They are. The EU is focusing on choke points banning services like insurance and port access to Russia's oil and gas fleet. And they just extended all the current sanctions through July 2026.
And they keep adding to that shadow fleet blacklist, right?
Dozens more tankers. They're forcing Russia to rely on this increasingly risky and very expensive network of aging ships.
And this is where the sheer level of detail in these sanctions becomes, well, almost absurd. The UK's late December sanctions, which are just now taking effect, they didn't just hit big oil companies.
No, this is where it gets really interesting.
Okay.
The UK also sanctions Central Asian companies involved in exporting cotton pulp to Russia.
Cotton pulp. That sounds almost comical until you realize what it means. The fact they're tracking that shows this isn't high-level diplomacy anymore. This is like industrial espionage by bureaucracy.
It is, because cotton cellulose is a critical ingredient for nitrocellulose,
Which is the base component for
gunpowder, explosives, and missile fuel. Moscow has always relied on imports for this, and shutting off this specific supply chain is reportedly causing serious problems for their defense industry.
Wow. It just shows the extreme depth they're going to now, severing every single military supply chain, no matter how obscure it seems.
And the overall effect is clear. The oil price cap alone has already slashed Russian oil revenue by an estimated 25%. It's a massive, measurable drain.
Okay, let's pivot to China. If Russia is trading stability for conflict funding, Beijing is dealing with a totally different set of internal cracks. It's less about external pressure and more about a domestic confidence deficit.
That's a good way to put it.
What's the credibility gap in their recent numbers?
Well, the gap is substantial. Officially, GDP growth for 2025 is around 5%.
Which sounds pretty good on paper.
It does, but independent estimates from Reuters, from the Rhodium Group, they put the real number much lower, closer to 2.5% to 3%. And whatever momentum is there is increasingly state-driven. It's not coming from genuine household consumption.
And you see that lack of consumption in their inflation data, which is actually too weak. And that's a bit weird, isn't it? You'd think low inflation's a good thing.
In this case, no. Consumer inflation is barely positive at 0.8%, and producer prices are actually in deflation. They're falling.
And that's bad because
It's terrible for a major economy. It means people and businesses lack confidence. It encourages everyone to hold on to their cash, waiting for prices to drop even more. It stalls big purchases and reflects genuinely weak demand.
and nothing kills consumption like the fear of not having a job, which leads right to the youth employment crisis.
It's a massive vulnerability. You have 12.7 million university graduates about to enter the labor market this year. And what's deeply concerning is that youth unemployment was last officially reported at around 18 to 20%.
And then what happened?
Then they suspended the publication of that specific data.
They just stopped publishing the number because it was too high. That in itself is a huge indicator of stress.
A massive one. When 1 in 5 graduates can't find work, it's not a statistic. It's a social crisis. It crushes long-term confidence in the state's economic management.
And this all gets amplified by the ongoing property market drag, which has been in a slump since mid-2021.
It's the single biggest economic stressor. About 70% of household wealth is tied up in housing.
And the government is trying to step in, right? They're buying up unsold homes.
They are. They reaffirmed that policy just last week. But you have to ask, are they fixing the problem, or are they just transferring toxic assets from private developers onto the government's balance sheet, using state debt to hide the issue?
It's hard to rebuild confidence when your family's biggest asset is losing value.
Precisely. This continued wealth erosion slows everything down. Fewer kids, delayed marriages. The state is powerful, but the people are losing faith in the structure.
But they still have these undeniable strengths. A record trade surplus $1.2 trillion in 2025, and they are pivoting away from the U.S. as a trade partner. Doesn't that kind of state control outweigh these internal flaws?
Beijing certainly has the capacity to stabilize immediate shocks. We saw the 2 trillion yuan local government debt swap just announced. That buys them time. But they are using debt to patch holes, not to solve the underlying structural problem of weak domestic demand.
So we're looking at a system that's incredibly powerful on the outside, an export machine, but increasingly brittle on the inside.
That's the takeaway. China's economy is becoming less innovative, more brittle socially, and fundamentally more state-led rather than society-powered. Success is being measured by the government's debt capacity, not household strength.
Which brings us to the summary of this whole deep dive. We've seen Russia paying for its war by slowly squeezing its own population into a poorer future. While China is navigating these formidable internal threats, deflation, a youth crisis, a property bust, that are really testing the credibility of its entire economic model.
And in both cases, the health of the economy isn't being measured by the prosperity of the average person anymore. It's being measured by the will and the debt capacity of the state. And that's an inherently unstable measure of success for any global power.
Which leads us to our final provocative thought for you to think about. If that U.S. secondary sanctions bill against Russian oil buyers naming China, India, Brazil actually moves forward, which vulnerability cracks first under that pressure? Is it Russia's desperate need for that oil revenue, or is it China's brittle trade pivot that's trying to replace the West with Moscow?